It's a pleasure and honor to be in front of you. Basically, there are many things which goes in the name of quantitative analysis. And whatever we do using numbers is quantitative analysis. So the market research, even what we call program trading and so on and so forth have been in existence for practically several years or several decades. And I recall there was a crash in 1987 in New York Stock Exchange where markets fell by almost 25%. And that was blamed on program trading. Now, what was the program trading then? There were not many computers. And how did the program trading happen? Basically, it was rule of thumb that if market goes up by, say, stock price goes up by 2%, then you buy more because you have a perception that a momentum will persist. So those were basically what were called programs. They were rule of thumb, not using computers. But now, what we call quantitative analysis or analytics is usually we mean by when we say it's analytics, we mean by using computers. And then I think a few words kind of get mixed up. One is the big data, other is analytics, other is quantitative trading, and so on and so forth. And they are, in a sense, different things. In a sense, they are the same thing. So, I come from stock markets, and I have also worked in retail. I worked in oil and gas. I worked in cricket and many fields where you end up using some amount of data, some way of sort of figuring out what is happening and then taking decisions. So it's basically why do you use data, right? Why would you collect so much data? Why would you use that data? Is basically that somewhere you want to bridge the current or past with the future. Why would you want to do anything with data or analytics or anything, even whatever we want to do, is basically you want to predict the future. And there are many ways to predict futures. If you watch Indian television, most times you see, at least on one of the channels, somebody telling you your future for today, saying, today, if you are Pisces, then you will start traveling. And 1/12 of the world has to travel on that day, right? If all Pisces have to travel. And sometimes the person is ill, who is basically supposed to speak. So his previous stuff is done, and it works because people believe. So effectively, there is a way to predict future which is based on the past data analytics somebody would have done on people's palms or some planets and stuff like that. But it's an inherent nature or inherent sort of curiosity of humans to control the future, to predict the future. If you can't measure, you cannot predict, then you cannot control. And that's why, basically, why we do all these things, whatever big data, analytics, and so on and so forth, is basically about predicting future. You want to, if you're in marketing, you want to, or if you're in sales, you want to predict sales. If you're in marketing, how many people are going to like a particular cream or so on and so forth. You want to do many things. If you want to start a movie, you want to know what people like based on analytics of the past movies which were hit, saying if you do this 20 things, people will end up liking it. And so if you put in those 20 things, probably, or if you take this movie star, you will end up taking this. In stock markets, we have been used to doing this, but the way things happen in stock markets are on two different planes, or probably many different planes. One is what I call very short duration activities. It is nothing to do with big data in a sense. You take the data on a very short time frames of milliseconds or seconds or minutes. You predict the next millisecond or next microsecond and do the work accordingly. And if you are able to predict even in that small place or small time frame, you are able to you are able to make huge profits. And you can have models which are sort of very mathematical, and you can have hunches which are not so mathematical. But effectively, what you do is you take the data which are coming at that pace, you eat them up, as I call them. Basically, you churn the data, you eat it up and churn, and then you come out with your answer, whether you want to buy or sell, and so on and so forth. So that's basically the perspective with which I have been working on what we call high-frequency trading. 5 years back, or six years back, when I joined BSE, we used to have around 10 million orders a day. We used to give a response time of around 300 milliseconds. A response time is when you place an order, you get a confirmation. That round trip is called response time. And we used to give in 300 milliseconds. In 1 second, there are 1,000 milliseconds. So it's around 1/3 of a second was a response time. When I started automation of stock exchange in 1994, we used to give a response time of 2 seconds. Those days, 2 seconds was very, very fast. Then when I joined BSE after 10 years of gap somewhere else, it was 300 milliseconds. And 1/3 of a second, humans usually can't decipher 1/3 of a second. But suddenly, the automation started in such a way that people started eating up more and more data, things became faster. And we went from 300 milliseconds to 10 milliseconds in a three-year period. And from 10 milliseconds to 6 microseconds in another 3-year period. In 1 second, there are a million microseconds, 10 lakh microseconds. So today, we give you a response at 150,000th of a second. That is the kind of response speed which we give. Now, why would anyone take that speed, right? Because humans can't decipher. If you try to think and place an order, it takes you a few seconds. Even if you're just blindly pushing it, you can't do it probably twice, thrice a second, and so on and so forth, because orders to come back and so on and so forth. Here, you are taking data at speed, practically speed of light, 150,000th of a second. And probably next couple of years, we might go into nanoseconds. That's 10 raised to minus 9, and so on and so forth. Why I'm giving you this perspective is that we used to get a million, say 5 to 10 million orders a day. Today, after increasing the speed from 300 milliseconds to 10 milliseconds to 6 microseconds, now we are basically getting around 50 crore or 60 crore orders a day. That's 500 to 600 million orders a day of 6 hours. On many seconds, we would be getting 60,000, 80,000 orders in a second. And it's basically, it's like earlier, we used to say, when I started the automation of stock market, screen-based, people used to feel that now less time will be spent on trading, but people started trading more. Similarly, earlier generation, especially in Western Europe and US, when the automation of washing clothes happened by washing machines, people thought now ladies will have to spend less time. But guess what? They started washing more clothes. So that's what ends up happening all the time. And you need to basically be aware of whatever is happening now is phenomenal in terms of your ability to take the data, crunch it. And in my business, some of you may not be from stock markets, but in my business, in any other business, if you get information ahead of others by 1 second, by 1 millisecond, by 1 microsecond, you are a winner. Provided you are able to churn that data, take a decision, and execute faster. Because you get to stand in the queue ahead of others. To give you a normal life perspective, do you watch cricket on television? Right? Most of you would have watched cricket on television, and it's real time. It's basically as it is happening, you are watching it. But it's actually around 4 to 5 seconds delayed. There are around 32 cameras across the ground. They capture the images. Then it goes into the control room in the stadium. And out of those 32 images, one is selected. It is sent to the television channel's control room. And then it goes to the satellite and comes to you. Satellite is around 36,000 kilometers on top. So 72,000 kilometers around 1/4 of a second in a kind of a time speed framework. So effectively, by the time it is mixed, matched, and stuff like that, it is around 4 to 5 seconds delayed. And by the time the ball has crossed the boundary, your bowler on the television screen is still trying to bowl. And that is the difference. Suppose you are watching cricket match and you tell your girlfriend that next ball is 6. And then next ball is 6. Next ball, it doesn't happen that whatever you say actually will happen. But if your friend is sitting there in the stadium, he's on mobile with you, and calls you up saying next ball is 6, you tell her it's next ball is 6. Then next ball is out. And so after 6 times, she might think you are a genius. Because she doesn't have the person sitting in the stadium and giving her information on mobile phone, and you do, right? That is the only difference. The reality is actually happening, but information comes faster to you vis-a-vis your girlfriend. Now, that is where you are standing in the front compared to her. Because she is getting the normal television, you are getting also information which is like 5 seconds early. Now imagine if you can execute on that information vis-a-vis the other person who doesn't have it. Imagine your girlfriend is a bookie. And then tell that next ball is 6, and she says, no, it's not. And you say, okay, give me $100 if it is not, otherwise I'll give you 100. And then you start making money, right? So that is as simple as that. If you get any information faster compared to others, you end up making money. And if you can execute faster compared to others, then you end up making money. So what happens is, today in stock markets, there is something called co-location facilities, where the computers are sitting next to the exchange computers within few hundred yards or few hundred feet distance. And even if your cable length is, say, 1 feet or 1 foot larger than mine, then you are worse off. You are probably few nanoseconds worse off than me. And that is a danger to the person who is trying to play on speed. There are people who play on trends. There are people who play on other things. So we have players who do basically speed-related activities. Then there are players who do trend-related activities. And people who actually invest, that is, basically invest over 5 years, 7 years, and so on and so forth. So imagine if you are, if human life was about seconds. Seconds were like too small for us to act, right? And so a second and a week became pretty differential activity. Clocks were invented and second was actually measured. But imagine now it is in microsecond, 1 million microseconds. The universe has stretched. So it is like going in a bullock cart when you are talking about seconds, vis-a-vis going in a rocket when you are talking microseconds. And that universe of trading is very different from the universe of trading in second basis. And imagine people who invest in years. They are like Brahma's years, Brahma's minutes. I mean, it will be like millions and trillions of situations. So effectively what is happening is that we are going smaller and smaller in time measurements and activities. And human scale is very different. And that is creating a lot of issues. There are, internationally, there are real worries on what we call HFT, high frequency trading. Today, as I told you, we get around 500 million, 600 million orders on a good day. 95 to 97% of all orders in Indian markets, especially stock markets, come from computers, no humans involved. Programming is done of various types, momentum or arbitrage between two markets and so on and so forth. Computers are basically eating the data and spewing out huge number of orders. And when price of an underlying changes in derivatives or anything, they take it back and push another set of orders. And so literally the order to trade ratio, that is if you had 3 orders to 1 trade, today it is in the range of 100 plus. So what is happening is, like in a simple example, it's like a shopping mall. Earlier used to have 3 people window shopping, out of which one guy would buy a shirt or pant or whatever. Today, 150 people are coming and only one is buying. And you need to create the capacity for those 150 people to come, because otherwise even that one trade will not happen. But you also need to worry about the malpractices that can take place on this smallest of time. Suppose my cable, by having a sort of a arrangement with somebody in the exchange area, is kept, say, 10 feet smaller than everyone else's cable, then suddenly I have that advantage. In fact, in India, there was a court case last year on this issue itself, where people claimed and the exchange actually lost the case. In fact, still it's in the court, in the higher court, but effectively there was a court case which said that some people are getting information faster on systematic basis by arranging or having arrangement with the exchange or exchange employees. And that was the allegation. It's basically about corruption and not about regulations. What are the basic principles of running exchanges? It is basically fair, efficient, and transparent. So this is unfair. If you give information, more information to somebody vis-a-vis another, it is unfair. If you give faster information vis-a-vis another, it is unfair. And also it is not transparent. That is, only few people are able to do it without other people's knowledge. If everyone knows that this is possible and you can pay the money and get it done, then everyone will do it. But so it is not fair, it is not transparent, and it is efficient for few, not for everyone, right? So that is where many times what happens is, as regulators, we are made to believe that since there were no regulations, now we have to create more regulations because we don't have the courage to actually catch the wrongdoers and punish them. So each time a wrongdoer is a senior activity or senior sort of organization, then we don't want to punish them, and we want to create more regulations to project to the public that we are acting. And those are the issues currently not only India is facing, internationally this is the case. That there is a book called Flash Boys by Michael Lewis. Whoever gets a chance should read it up. He talks about many such things happening in US. In India, we are very tightly regulated. Our regulator is very sort of forward-looking. They catch this trends faster. India, I mean, SEBI was the first regulator in the world to come out with regulations on high-frequency trading around 4 or 5 years back, and they have kept on improving. But effectively, internationally, this is the issue. And there are many countries like Germany who wants the algo traders, as we call them, or HFT traders, to take certifications which are specialized. There are other countries where there are many other regulations that have been put into place. And so that is basically as far as the high-frequency trading, as we call it. And that is part of analytics, but in a much more interesting sense. Of course, the analytics is used in economics to predict a particular company's prices and multivariate analytics and so on and so forth, or even how the country is going to do or how an economy is going to do. But it's basically, as I said, predicting future of larger activities, of smaller activities, smallest time frame, larger time frame. As regulators, we also worry on the other parts, that is surveillance. There are many people wanting to manipulate, and it's easy to manipulate using algorithms. And people won't even know if you are smart to do manipulations. So we need to have algorithms which actually match and figure out all these things. So we used to have a situation where people will place orders. Like I would place an order from a broker, and same broker I will place another order for the same stock, and my orders both will match, and people will think that trade has happened. But actually it's not a trade because both sides is me. And so I'm trying to take the price from 10 to 12 to 15 to 100. And that's called wash trades in our language. And it's creating a fake market to get people interested in something which is actually not so interesting. And so SEBI started catching this, and they started penalizing people who were doing it. So we said, if we are allowing this, then only it happens. So because we do automated trading on screen, whenever orders come, now it checks whether the same person is there behind. We have a client code. If it's the same person, the incoming order is cancelled. Then they became even smarter, and they started going to another broker. So you have the same person on one broker as a member, and he goes to another broker, and he becomes a member of that, and he starts placing the same stock order, and they get matched, and again it starts putting trigger. So we have something called PAN number in India, which is your income tax assessment number. And now the software checks before matching whether it's the same PAN number. If it's not, it will not allow that. And so it cancels the incoming order. Then they started even becoming smarter. And so in the morning, I'll buy with you. When you will sell, I will buy. In the evening, the same stock, I will sell, you will buy. So it's called reversal. It's called trade reversal. And so now the software checks that if you have an open position on buy side and open position on sell side, when you reverse the trade during the day, it will cancel the trade. So each time a thief or person who is manipulating does something, we have to capture something and then sort of ensure that systematically we remove it. And there are many other patterns which our software catch, and it's given to our software team. SEBI also has such softwares and alerts and all, and then they create investigations. They go back, check it out, the backdated things and so on and so forth. But we use a lot of analytics for running the markets, as we call it, to make it safe, fair, efficient, transparent. A third thing is the big data. That big data was a buzzword, and I used to run a telecom company long time back, around 2000 onwards. And we used to be getting all the largest amount of data. And those days, 5 TB was a big number, 5 terabytes. And I used to be the IT head of that company. And our data, big data or big database was considered 7th largest in the world those days. And we started realizing that the way the software companies charge money for putting your data into those databases is humongous, and the data is increasing in size so much that if it's going to cost so much, probably all the companies are going to earn only for the database providers, not for themselves. And so we said we need to go for the open source kind of activities. We started experimenting. When I came to BSE, we had a 5 terabits data in 2009, and that was considered reasonably all right. But we were paying around $1 million a year to just the license fees for the databases and operations on that. And we were going to increase our speed, and we expected the number of orders to go up. And we said, if this becomes 100 times larger, then $1 million will become $100 million, and that's not my income even. So how will we be able to manage the data? And so we kind of contracted with a party who agreed to transfer all our data into open source. And actually, the total cost of changing that from the proprietary data to open source was around $250,000, including hardware, which gave us capacity of 500 terabytes, 100 times more in 1/4 the cost. And today, we are adding few terabytes every day. And it allows us to scale because we are able to, it's an open source, so we don't have to pay license fees. We have to just add some commodity hardware and so on and so forth. And today, we also allow on the screen, on internet, people to backtest their algorithms, because when you want to trade on stock markets, you want to check your algorithms, backtest with back data, and say whether it is meeting what you have predicted. And so basically, artificial intelligence is used and so on and so forth. So we have now put out the entire data on the internet. You can check it out, all your database, sort of your algorithms on the previous data, and see your predictions coming true or not, and so on and so forth. And then bring that data. Once you are comfortable with your strategy, you can come in, put it on the real-time data, which is real trading, right? And so we do many such activities, from the minutest to and smallest time zone to years and sort of 100 years data and so on and so forth. And we sell many of this data. Some of this we give free. But like, for example, the Sensex data you will get for last 39, 40 years and so on and so forth. So you end up getting sort of long time series and very sort of tick-by-tick data, as we call it. If you have 500 million orders, you can get the order book at each of those 500 million sort of time periods in the day, and so on and so forth. And of course, if you have other exchange data or other exchanges in the world data, you can actually make your predictions even more interesting and your analytics more interesting. So I just wanted to give you a flavor of how the stock markets are using all these things. And there are many other businesses which use big data, and how we try to reduce costs because it can kind of go haywire. Even in our trading system, which is on microsecond basis, it's completely on open source. We were on proprietary trading system, and we realized that the costs are phenomenal, so we had to go on open source. And the reason many people ask me that, then what happens if things go wrong? Who will support you? And I say that when things go wrong, no vendor has supported me ever. Although I have paid a lot of AMCs, annual maintenance contract fees, but they only promise when I'm in trouble, I am the only one in trouble. No vendor is in trouble. And better I start taking responsibility for myself. And if Google or Facebook or Twitter can run themselves on open source, I can also try to learn and reduce my cost. And that is what we have been able to do. So I just wanted to be aware of what is happening in Indian markets. Indian markets are amongst the most sophisticated stock markets in the world in terms of the number of companies listed, the type of activities that happen, and even on the HFT front, we are practically amongst the largest in the world, although we are not so happy with the allegations and so on and so forth. But currently, India is adept at taking on newer things and doing things with it. Every home has a software engineer practically, and they end up coming to stock markets because stock markets is easiest way to make money, at least in people's minds. It's not so easy, but it ends up giving that projection. So a lot of people want to come in, and that's why we have almost 95, 97% of all orders coming through algorithms, and probably 70, 80% or more trades on many derivatives areas and so on and so forth coming out of algorithms. It is, people perceive or people fear that most of it over next few years will become algorithm oriented. But how do you stop the march of technology, right? And the traders are feeling bad. The investors, actually, they are into a different zone, right? They invest for years and so on and so forth. But that microsecond thing is creating a lot of worries in people's minds. And most of the debate you see now in Indian markets and international markets is about this. So Hillary Clinton, who is the candidate for presidentship in US this election, she has put in her manifesto that if she comes to power, she will put a huge tax on people who do high frequency trading. So with that, I'll close. Thank you very much.